The WealthManagement.com Advisor Innovations podcast is sponsored by LPL. As financial advice continues to evolve, LPL is at the forefront. Whether it's growing your RIA or building an independent practice, advisors can pick the business model, services, technology, and product mix that best meets their clients' needs. As a top wealth management firm 100% dedicated to advisor success, LPL looks forward to learning how they can help you build your tomorrow today. For information and show notes, go visit lpl.com/advisor innovation.
Hey everyone, thanks for joining us. This is the Advisor Innovations Podcast. I'm David Armstrong, the editor of WealthManagement.com. And this, as you know, just simply a podcast that exists purely so I have a chance, an opportunity to speak to the folks in the wealth management industry who are pushing the industry forward into new and interesting areas across the board. Asset management, broker-dealers, custodians. And today I'm thrilled to be talking to Bruce Bond, a pioneer in the exchange-traded fund space. Bruce is the founder and CEO of Innovator ETFs, which holds nearly $8 billion in AUM across 90 ETFs. Bruce, thanks very much for joining us.
Thank you for having me, David. I'm looking forward to it.
Well, this has been great because I can't think of a more innovative exchange-traded fund company than Innovator. And your previous firm, PowerShares, which really kind of charted new areas in the entire asset management space for exchange traded. And before we begin, I'll mention that you 3-time award winner for the WealthManagement.com Industry Awards for ETFs.
Yeah, over the last 3 years, each of the last 3 years, yes.
That's. I don't think there's any company that has a better track record. And you've been a finalist for CEO of the Year for our asset management categories, including this year, up against some pretty heavy competition.
Yeah, I'm privileged to be a part of that group.
It's fantastic. And I think it really speaks to what our judges see, the benefits that you bring to financial advisors, really, because those awards are all about the financial advisor, what helps financial advisors create better outcomes for their clients. And these are defined outcome ETFs. So why don't you just, before we jump into it, take a step back for folks who don't know you, don't know the firm. Could you just kind of level set for us, Innovator ETFs, who you are, where you're coming from, what you do?
Innovator ETFs got started in 2017. And I came back into the industry to start the business along with my founding partner, John Southard, who was with me at PowerShares as well. And we saw that there was a tremendous need within the advisory community to be able to control risk outside of just bonds, or outside of just hoping for correlation to protect them during difficult times. And we saw some of the insurance products that were available and structured products that were available, and we're intrigued by the payoffs. And we are huge believers in the ETF structure itself and in its ability to deliver most of the performance in the most efficient way possible to investors. And so we began, we kind of embarked on our journey at that time to figure out how could we put some of the most basic payoffs that would provide real risk management capability and tools to advisors that they currently didn't have access to. And Innovator ETFs was born out of that.
Yeah, and we should say, if you want to just real quickly give us the gist of how the Buffer ETFs work, right? This kind of minimizes downside risk while also kind of capping upside risk, but that's the payoff you take.
Yeah. The first products that we introduced are called Buffer ETFs. And these were the first. It took us a year and a half to get the SEC to approve those products. And, we wondered if we were going to get them approved sometime because they are a first of their kind. Yeah. And what they do is they give people the opportunity to participate in the equity markets with a cap on the upside, but with a known buffer on the downside. So we started with 3 different buffer levels on the S&P 500, for example. So you could have a 9% buffer against losses, or a 15% buffer against losses, and that would be from 0 to 15. So over a year, if the S&P was down 15% or less, you would lose no money. If it was down 16% for the 15 buffer, you would lose 1%. And then we also had a 30 buffer. Now with the 30 buffer, you're actually exposed for the first 5%, but all the way down to 35% after that, you had no risk of loss. You just have that first 5%. Now, after 35%, you would begin to lose again. So it is a buffer against losses for these certain amounts on the downside. And they have a prerequisite cap on the upside. And basically what we're doing is selling off, the potential to get extra upside in order to buffer or to create some protection, a level of protection on the downside. And people were very excited about, having the opportunity to do something like that.
Yeah. The thing that strikes me about them is that you're very transparent about that trade-off, and these are transparent products. Previous to Innovator ETFs and these ETFs that you created, what was an advisor's option? You say the structured product market, annuities, insurance, and it was just very it was not transparent, right? And expensive and
right, exactly. They were illiquid. They were not transparent, so you didn't really know what you owned. They were also, it's a taxable situation every year. It was very difficult for most advisors to incorporate them in their business, as they tend to be fee only. And therefore, how do you incorporate something like that in your business if you're fee only? Whereas, with the ETFs, it's easy to incorporate those in your business. They're transparent. And I think the big thing is, from a tax perspective, we don't expect any cap gain distributions. So here again, the ETF structure brings the tremendous value of growing your assets on a deferred basis, a tax deferred basis, until you actually sell the ETF. And so it brings all these tools and all this value to the table that currently didn't exist before. Another thing that I'd like to just mention real quick, one of the things that we had to come up with was a tool so that you can participate in these like right around their beginning, when they reset, or you can participate anytime during the outcome period. All you have to do is, go to the Innovator website, look on there, and you can see how much upside you have left, how much downside buffer you have available. And so you can see at every moment within the day exactly what your payoff profile looks like. And so we have a lot of people participating in the middle of these outcome periods, not necessarily. Most of these are over 1 year. We have some quarterly products, but most of them are over 1 year, especially the buffers.
They're reset every year.
Yeah, they're reset over 1 year. So when we say you get, like on the 9 buffer, most recently, you get 20% of the upside of the market. You have a 9% buffer on the downside of the market, and that would be where the product finishes in 1 year. That would be your payoff in 1 year if you stayed in it. But we have a lot of people just saying, hey, I'm going to trade out and I'm going to buy this new one, or I'm going to get in the middle. And, we have a lot of that happening within the products. Once you buy the product and you get comfortable with it, you start to realize that there's a tremendous amount of opportunity to use the products for interim periods as well.
Yeah. And you can see those bands as they move
right.
During the course of that period. You can see that information on the website. Yes, you know what you're getting.
Yeah. I encourage everyone to go to the website if you have any interest, because there's a tremendous amount of information there that you would be able to glean about the products.
Well, I mean, and the market has really spoken, right? The market has found these valuable. The inflows, I think, set records over the past 2 years. It's been a success by the market standard. Yes.
Yes, it's been a tremendous success. The other thing I would say is that these still aren't available in any of the wirehouses. These are just available primarily, and other than at Raymond James, they're available at Raymond James. But other than that, for any major distribution, these are not available. And firms like Raymond James are making a lot of headway with the products as they, start to realize their value.
Would you care to hazard a guess as to why they're not making headway in the wirehouse?
Well, it's difficult to really understand. Some of you are familiar with the complex product rules that have come out, and that has made some of them concerned. And we obviously compete with a lot of other in-house products at the firms. Mm-hmm. And so that's a challenge as well, as they attempt to determine, the best way to go about incorporating the Innovator product line.
Yeah. They're not strangers to innovative products.
No.
Or complex products.
Yeah, they have all those. They have all these products actually that we have. They have all these products. It's not new. It's just that ours are in an ETF versus a note.
There may be some economics at play there that are not necessarily favorable to them, but favorable to the advisors and the investor.
Right.
So I was going to ask, in the recent, I don't know, month, 2 months here, that the markets have seemed to fluctuate and fall apart. What happens to your ETFs? What happens to flows? What happens to your benchmarks, your resetting? Does it have a significant effect? How are your ETFs holding up?
Yeah, they're holding up tremendously. And obviously, we have been for over a year now warning people that, you cannot pump the amount of capital that was pumped into the market without having to pay the pauper one day. And, that rooster has come home to roost. And we think that we're in a little bit of an elongated flat market here or slightly up market. I mean, we could get a rebound in some of the stocks, but we think it's a time to be very careful. And the wonderful thing about the buffers, we just keep it simple there, is that the caps expand during volatility. And so I mentioned the 9 buffer a minute ago. At the last month here had a 20% cap. Last year this time, it might have had a 14% cap or something like that. So you can see the cap has moved up by 6%. Mm-hmm. And so during volatility, the cap moves up, and also during higher yielding. So when stocks yield more, there's more budget in order to be able to buy more of the options that are necessary to structure these products, and therefore the cap moves up as well. And so during volatile, high yielding periods, the caps are very good. And what we have seen is that last year, we had what we would say is a decent year. We did about $1.5 billion in new assets last year. But this year, we've already surpassed probably $2.5 billion or $2.05 billion or something like that in new assets this year. And so there's been a tremendous amount of interest this year in the products as people, they're starting to look at the 60-40 and they're saying, okay, this has been a tremendous ride over the last 10 years when stock went up and bonds went up. But, should we expect that going forward? And I think with rates where they are, you just don't have the upside available in bonds anymore or the yield. Yeah. And so they're looking for some alternatives. They're looking for, how do I provide or reduce my risk in equities without necessarily having to count on that, the bond portion? What else can I do? And as people rethink how to structure their portfolios, they're looking, a lot of them, to the innovator products and buffers and those types of things in order to be able to improve their outcomes, but also the knowledge of what their outcome will likely be. It gives them more control over that. And that's what so many advisors are comfortable with in their clients.
Yeah. I could take this in two directions. You've also launched a product for bonds as well, using the same buffer structure.
Yes, exactly. TLT. We have 2 products on TLT. One is a floor, which has performed great. Obviously, if you own TLT, has a floor on TLT, and you have a cap on the upside of how much you can make on it. And if you kind of look at, okay, what really gives you negative correlation to equities in the bond world? Well, you can get it out of the ag, but I mean, if you really want some good negative correlation, you need to go out on the duration scale, and TLT tends to be the best counterbalance, but nobody wants to go out of there because it's pretty scary out there on the end, So I think what this does is take some of that risk tail off for people and gives them the ability to have that negative correlation, hopefully, that they're looking for, but not with as much risk. It's similar to a buffer, but what a floor does is you have exposure to the first 5% down in the market, and then you have no more risk after that. And I think that is what's attractive for people as well. They'll take a little bit of risk with their exposure in the fixed income space, but they don't want any more risk after that. And so we're also crafting positions like that for people that are looking to take risk off the bond shelf.
It's such a story, of these buffer ETFs that seem tells itself, and I know they're complicated under the hood, but when you go out or were going out to advisors right off the bat with these products, what were the questions that advisors were asking you, and what were there any points of resistance, or did you have to kind of convince them of the merits, or what were those early discussions like?
I think we did some, yes. I mean, I think that, we went out with a very simple story. And the simple story was buy the S&P with a downside buffer.
Mm-hmm.
Now, remember when we started selling these, the S&P it had been charging up for a long time. And people were like, okay, well, this could turn around one day. And I'd like to have a buffer against losses when that happens. So those people got in early and, they were probably protected during this to a degree, by the buffers in this recent downturn. Well, and so we keep it simple. It really, I like to say it's on face value. It's not that complicated. You buy it, you get the buffer. As long as you buy right around the beginning of the month when the new month is offered, that's what you get. And there's not a lot of rocket science to it. But when you want to start evaluating buying in the middle and things like that, then, you got to make sure you do your homework. But by and large, I think the early adopters, many of them may have been at a wire and they love structured products. And they were like, but you know what? The problem with structured products is I really can't incorporate it easily in my business. Mm-hmm. I got 1,000 CUSIPs I'm trying to keep track of. I don't know who owns what and what they own. And the whole commission structure, the tax thing, the fact that they're not transparent and liquid, they just, a lot of them were looking for a solution. And that really is what we've brought to the table, a solution to all the things you didn't like about a note and what's in a note, solved for that and brought that in an ETF and actually brought extra benefits to the table, like the tax benefit, the counterparty risk, but it isn't a note, right? So you're not putting in a reliance on a bank. And those types of things brought those things to the table. And so many of the earlier adopters were very familiar with structured products. And they were like, this is a no-brainer. And so that's how we got started. And then from there, we had to just continue to explain to people, you're just buying the S&P 500 with a buffer, or the EFA with a buffer, or the emerging markets with a buffer, or the NASDAQ or the QQQ with a buffer, and that's what you're doing. So if you want to own equities, but you're concerned about the risk you're taking, then you might want to buy this. We have a story we tell around here. I used to always talk about it when the business was getting going, but most people are in the market naked. They just buy equities and they just are along for the ride. That is their only hope, that the market goes up. People that started that in January, maybe retired last year, got all their money in, didn't have a proper plan in place. And even if they did, they bought bonds and equities. I mean, they really got hurt. And so what else is there that can give you the ability to understand over the next year, this is the amount of, or this is the level of protection that I have available to me over the next year. And this is my potential upside. And what we find is most people, when you talk to them about it, they're like, you know what? They're willing to give up excess upside to have a buffer on the downside. And, sometimes it doesn't make sense when everybody's just making all kinds of money and the market's going straight up. But then you get into a market like this and people are like, absolutely, they're expecting low double digits or single digits over the next couple of years. And they're like, yeah, this makes total sense for me.
Do you find advisors are using these? Have they changed how they're incorporating them into their clients' portfolios? Or have they moved more towards a core holding of sorts, or how have they?
They have. We have a lot of nice size trade, $80, $100 million trades these days. As people start to look at how to, different ways they want to incorporate them in their business. And what we're seeing is some of those kind of a third, where advisors are saying, I'm going to put a third of my assets in the buffers. I'm going to keep a third in equities. I'm going to have a third in bonds. But what it tends to do is to reduce volatility and give them potential for better returns down the road as the equity market gets going. So they're becoming a little less reliant on the bond side by having the buffers, but attaching that conservative position to their bucket. And right now, most advisors, and expectantly so, they look at their portfolio kind of like, equity and bonds. I have bonds for this, have equities for this, but they don't really think bigger, like, okay, they don't think necessarily just in terms of risk. How much risk do I want to take? What does that risk look like? And how, and primarily, I think a portion of that is that, the risk, they only have so many tools to be able to control risk.
Right.
And because of that, those are kind of the two knobs that they turn. I mean, obviously there's annuities and structured products and hedge funds and private equity and these kind of things. But in terms of having the knowledge of what your or a better knowledge of what your outcome will be over a year, or more control over that, that's a new thing for most advisors to have available to them.
I agree, because I was from our side of the table. When we look at the advisor landscape, we see kind of bifurcating into the advisors that are just going to say, asset management is not my value prop, so I'm just going to outsource that to whatever model or whatever outsourced asset manager I have, or I'm going to lead with my asset management chops. And I'm sure you've run into a lot of RIAs who they got their own secret sauce, their own little their own particular options overlay strategy.
Oh, yeah.
And that's their value prop. But for advisors who maybe don't want to either go into the bucket of low cost Vanguard ETF model, or have a fancy soup of option overlay strategies that they lead with, there's really nothing in the middle for them.
Right. And this is something that gives them a tool to do that, and also allows them to sound very sophisticated, once they learn the product. I mean, because the products are sophisticated and very interesting. As I mentioned, most investors are willing to make the trade-off of giving up potentially upside. You don't know how high the market's going to go, but if you get capped out, anything above the cap, in order to have the buffer, many people in these types of markets are willing to give that up. If you think today, someone who wants to get into the market and get reinvested today, well, it could be the right time. It may not be the right time, but if you could do it with a buffer on the downside, if the market does go down some, that's okay. You have a buffer in there, but if it goes up, you're going to participate. And that's what a lot of people are interested in having. And what we're finding is the strategists are starting to incorporate the buffers in their model portfolios. And we think that's only going to grow. I don't think, I think that even some of the models out there, they tend to be the same, right? They're bonds and equities, and, they're trying, but many of them, I think when this year is finished, there's going to be a look back, and, we're all going to do an evaluation of how all these portfolios performed, and did they do what they were supposed to? And if not, why not? Mm-hmm. And I think there's going to be new attention paid to other ways to mitigate risk.
Yeah, it'll be a wake-up call for many.
One other thing I would add is that we do run into a lot of people that want to do their own options or put on some kind of an overlay, and what they start to realize with our product is that it's so inexpensive to be able, we're doing everything at an institutional level. And so when they have to go in and do this themselves, it gets very expensive for their clients. Yeah. And so to participate in the buffers, with the ETF, I mean, is far more efficient for them. They're not wasting their time. Now, they may say, well, this is my secret sauce and what I do, but many of them are incorporating the buffers. When I used to talk to many of the banks about these when the products were new, a lot of time the trading desks at all the big firms that trade options, they would say, yeah, this is what I do in my own portfolio, but why would I waste my time? I would just buy the buffers now.
Yeah.
So.
No, it makes a lot of sense. Do you notice, one of the criticisms of ETFs has always been that they're too easily tradable. Do you notice advisors or investors performance chasing in their own way with these buffer ETFs, moving in and out of them as they kind of make thoughts about which direction the market's headed in?
Some you do see some of that. Let me give you an example. If you bought the 9 buffer with a 20 cap, and the market went up 10% in 6 months, for example. And the fund doesn't travel in exact line with the spider. It might trail it a little bit because there's time value in the options in that. But let's say you're up 5%, the market's up 10%. It will match it at the end of the year, but mid-year, it's kind of trailing a little bit. We see people at the end of a month when a new product comes out, they may sell that and buy the new one. And the reason they do that is they are, in a sense, giving themselves a higher cap if the new cap is higher. And they're also locking in that gain that they have. So if the market were to sell off, now they have that 4% or 5% that they just got is somewhat buffered now. And so they move up with their buffer. So they will trade in or lock up as they go up. We have people doing those types of strategies in order to step up their buffer as they go along.
Oh, that makes sense. I wanted to, before we run out of time, talk a little bit about your background and your history. You come out of Wheaton, Illinois.
Yes.
And somehow Wheaton, Illinois has become the hotbed of ETF innovation in the country, apparently.
Yeah, I know. It is interesting how that all kind of is here at the time.
I've been to Wheaton, Illinois, and I
have you?
Wheaton, Illinois. It's a beautiful little town.
Yeah.
But on first drive-through, wouldn't strike anyone as the place where.
Financial hotbed.
Yeah, exactly. So how do you, what's the story?
Well, I think going way back, people. Well, first of all, John Naveen, is in Chicago. Naveen, everybody's familiar with Naveen, I would imagine.
Sure.
And so Don Sveen, among others, were all from this area. He was the president of Naveen at one time. John Naveen was not from Wheaton, but in this area. And then Bob Van Kampen, many of you are familiar with Van Kampen Merritt, that go way back. Bob Van Kampen worked at Nuveen, left Nuveen, started Van Kampen. Van Kampen Merritt was sold to Morgan Stanley. And so what happened was, and then Bob Van Kampen actually started Nike Securities, which became First Trust.
Mm-hmm.
And First Trust, is a big organization themselves, have dropped a lot of seeds in this area. I worked at First Trust at one time, left and worked at Nuveen for a while, and then started PowerShares and now Innovator. And so it's just been one of those situations here where you had these kind of forefathers of the financial, kind of the mutual fund industry and retail investing world in this area. And then there were a lot of people that worked there, and then there was a lot of seeds planted, and a lot of other people started their own shops and did different things. And so it's just continued to grow in this area. And that's primarily why it's here. Amplify as well. If you're familiar with Amplify, Amplify's in the area. Mm-hmm. So Christian Magoon, he was a former employee at First Trust. And then so Claymore Securities, if some of you remember Claymore, we all kind of stayed in the industry and worked through it here.
And there's a large retail-facing RIAs that are based out there too.
Oh yeah,
the Rockford, Illinois area, and the west of Chicago. Do you think that maybe that one of the reasons that happened was because it wasn't in a traditional, conventional financial services hub?
I think it could be. Yeah,
room for this kind of.
Yeah, interestingly enough, most of us came out of the UIT business, which is what First Trust was, Nike Securities, for the longest time. They never did anything but UITs. They still do. And if you think back to and the part that really the start of PowerShares, the dogs at the Dow and all this stuff that was done back then was really a quantitative approach to investing way back when. And so when we started PowerShares, we had done, many types of quantitative approaches to selecting portfolios, kind of like the dogs in the Dow, but on a broader sense that reset every 13 months and this kind of thing. And, my idea at the time was to take a more sophisticated approach to that and create an index out of that quantitative methodology, which really was the beginning of smart beta. And we did that. We created these indexes called the Intellidexes, which were calculated by the American Stock Exchange, and they're now owned by the New York Stock Exchange and still calculated today and have ETFs based on them. And so we created these indexes that were kind of, intelligent indexes that used more quantitative measures rather than just dollar price or cap weighting.
Yeah.
To bring.
What you're talking about here?
That would have been the very first funds we did. That's what they did. So that would have been May of 2003.
Yeah. So long before smart beta became a marketing term.
Yeah, exactly. And nobody knew what to call them. Some guys called them, we call them IntelliDexes for the indexes, but they called them smart indexes and, and all. But then and we use factor investing before the factor term was attached to it. But, the reason, I think, it's kind of what I've always done is tried to say, where can I really bring value? Even when we started PowerShares, we were up against, State Street and iShares, which, Barclays back then, and the biggest of the big, right? And so I'm like, how are we going to make this work for us? And so I've always tried to create my own lane, and do something a little unique to what is out there, but makes a lot of sense for people. And that was the beginning of smart beta back then. And today, with Innovator, we're trying to do the same thing, give people a better way to control risk. And we believe that this market will continue to expand in time. And more and more things will come to market. And we already, since we launched, we do have several competitors in the market now kind of replicating what we're doing. And we expect more to come to the market as well. Yeah.
I mean, the defined outcome has become almost as much of a widely used marketing term as smart beta was back in the day.
Right, exactly. And it's, I don't know if you see the Brown Brothers survey that they do, but that's the number one thing people are interested in, finding, more ideas along those lines and seeing more ETFs along those lines that they can utilize in their business. And, typically when you see that kind of thing and that kind of interest building, there are more products come to the market that make a lot of sense. And we're just happy to, have been a part of introducing something like that.
Yeah, for sure. So I know we're kind of running out of time here, but I wanted to ask you, what's on the whiteboard? What do you think in the future? I mean, we're going to continue, I think, to see markets go down and down and down. I think.
Yeah. I think they're going to struggle here for a bit, and I think it's a great time to have a buffer. I mean, I really do. I mean, it's a little self-serving to say that, but I think it's a good thing to have, and you don't give up much to have it.
Any ETF innovations on the whiteboard there?
One of the ones, yes, we just announced a product that I think is going to be very compelling. And for advisors that would rather set it and forget it, and they don't want to manage, they don't want to use a buffer day to day and watch it and think about it and that kind of thing, with Parametric, who is kind of our partner on the product, that allows you to get most of the upside of the S&P 500, and we're rolling multiple options in there to create more income so that we can get more upside, and it happens automatically for you. Now, the one drawback to that is that you give up the defined nature of the product. It's not like I buy it today for this, and I know I'm going to get somewhere in this range or close to this range in the future. Mm-hmm. What you're doing is you're relying upon Innovator and Parametric's asset management capability. They've been doing this for a very long time to deliver that to you, but we think it's going to be a tremendous product. We're introducing one on the Spider and one on the Qs. Okay. So people can participate in either one, and we think that'll be a tremendous product. We're also, the other thing, I mean, interestingly enough, this, is a little different than our other products, but we have a floor product that we're working on for Tesla. Yeah, where you can get, up to, 30% of the upside of Tesla's performance on a quarterly basis, but you have a floor of 20%. So, you have a max loss of 20%, but you have the opportunity to participate up to 30% quarterly on the upside of Tesla. And, this is the only single stock that we're considering doing this with. But, we think that the potential for Tesla to have some downside is there. Yeah. And we want people, like for myself, I'm up, I don't know, 900%, 1,000% of my Tesla position. that I have personally. And, for me, I would think about just selling a position, rolling over into something like this. And in a sense, only having 20% downside on that position, going forward. And I don't know how much Tesla is going to double annually or anything like that. But I mean, you still are going to get, probably 25 to 30% of the upside quarterly. So we think some of those types of products can be interesting for people that maybe in a one-off situation, but we still tend to believe that the core holdings of some of the accelerated, you get multiples of the upside with a buffer. We have some products where you get 2 times the upside of the spider and have a 9 buffer. Some of those types of products we think will be very interesting as we get into more limited upside markets.
Yeah, we didn't have time to talk about the accelerated funds, but this the notion of doing this for single securities is really interesting.
Yeah,
I mean, if the options market and the market is deep enough, right? I mean, you could see do this for Apple, you could do this for Google, you could do this for
exactly. We've looked at all of them, and I think we have some interest. What we want to see is Tesla's the one that's given up the least here, and we thought, okay, let's see how Tesla goes. If it goes well, then maybe we'll consider the others.
Well, this has been fantastic, Bruce. I know we're over the time, and I know I kept you longer than I intended to, but thank you very much for sticking with us.
Yeah, happy to be here. Thank you for having me.
Yeah, this has been the Advisor Innovations Podcast, and you've been listening to David Armstrong and Bruce Baum. Thank you very much.
This podcast is sponsored by LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial is a separate entity from and not affiliated with WealthManagement.com.